When people first start investing, everyone wonders, should you invest regularly or wait for the market to drop? This is a familiar showdown between two strategies: dollar cost averaging and buying the dip. One side believes that investing consistently helps reduce risk and creates long-term stability. The other side believes that only buying during deep market drops can maximize returns. But which strategy is actually suitable for most investors? Each strategy has its own pros and cons, and both are heavily influenced by human psychology. This video will explain everything in a simple and visual way so it's easy to understand. And by the end, you'll be able to identify which strategy works best for you. First, let's talk about the dollar cost averaging strategy, also known as DCA. This strategy involves investing a fixed amount of money on a regular schedule, no matter whether the market is going up or down. A simple example is investing $500 every month into an index fund like the S&P 500. When prices are high, that same amount buys fewer shares. When prices drop, you automatically buy more shares with the same amount. This helps average your purchase price over time and removes the pressure of trying to time the market. Another major benefit is that you maintain investment discipline even when the market is volatile. And most importantly, you stay invested in the mark. Next, let's explore the strategy of buying the dip, which means investing when the market drops. The idea sounds perfectly logical. Buying when things are cheaper should be better, right? But the biggest issue is that it's extremely hard to define how much of a drop actually counts as a dip. Is it 5%, 10%, or does it have to be 20% before you buy? Because there's no clear rule, many investors end up waiting far too long. If the market drops 5% and then quickly recovers, someone waiting for a 10% dip misses the entire opportunity. Ironically, the market often recovers much faster than we expect. That's why trying to catch the bottom usually leaves investors sitting on the sidelines instead of getting invested early. Let's look at a real example to understand the difference between these two strategies. In this example, Daniel chooses to wait for a major market drop before investing. Emma, on the other hand, invests $400 every month into an index fund. After 12 months, Emma has invested a total of $4,800 consistently and steadily. Meanwhile, Daniel keeps all his money, waiting for the market to drop at least 12% before buying. But if the market only falls around 7% and then quickly recovers, Daniel misses the entire opportunity. During that time, Emma keeps buying whether prices rise or fall, steadily accumulating more shares. And when the market rebounds, Emma's portfolio grows immediately, while Daniel remains on the sidelines. To see things more clearly, imagine a study that simulates different types of investors over 2 decades. One investor is unbelievably lucky and manages to invest at the perfect moment every time the market hits bottom. Another investor doesn't care about timing at all and simply puts all their money in at the start of each. Then there's a steady investor who contributes every month, no matter if the market is red or green. There's even someone who consistently has the worst luck, investing at the exact peak every single time. And finally, there's the investor who stays on the sidelines, waiting endlessly for the perfect deep dip that rarely comes. The results are surprising. Those who invested early and stayed disciplined outperformed the ones who kept waiting. It shows that success doesn't belong to the best predictor. It belongs to the one who sticks to their strategy. Even though buying dips sounds appealing, it's harder to execute than most people think. Being late by a few days can make you miss the entire rebound. Meanwhile, consistent investors gain an edge by staying in the market. Staying out too long keeps your money from growing. The goal isn't predicting bottoms, but keeping investment discipline. Long term, consistency often outperforms perfect prediction. Even though DCA gives steady results, it doesn't mean you must ignore buying dips. Many investors combine both, investing regularly while keeping cash for deeper dips. The key is avoiding endless waiting for a perfect drop. Market opportunities appear suddenly and fade faster than expected. With steady investing, you're always ready when the market jumps. With slight flexibility, you can improve results without losing discipline. In the end, the most important thing is choosing a strategy that fits your personality and goals. If DCA keeps you calm, make it a long-term habit. And if you enjoy buying dips, set clear rules so you don't end up waiting endlessly. Whichever path you choose, discipline and consistency will take you the farthest on your investing journey. If you found this helpful, feel free to follow the channel for more simple and insightful investing ideas.